To build anything that truly lasts, it takes time.
But how should you position yourself for today's trading session? To discuss that, we are now joined by Steve Englander, Standard Chartered Bank Global Head G10 Forex Research, now joining us. Thank you so much for taking your time out and joining us. First question is with respect to Trump tax bill, which has been passed by the Senate and now requires upper house's approval. If at all that were to be passed, how do you read this development and what does this mean for global equity markets?
Well, I think the market is still trying to read it. And some of the volatility we saw in the New York session today, I think, is because the market is trying out various reactions, isn't sure yet. My guess is that it would push up bond yields a little bit because it does seem that where they need to compromise, they compromise on papering over issues, either kind of spending cuts don't get made or tax increases are delayed and likely never to come. So I think that the bond part is reasonably clear. Equities seem to like it more or less, and the dollar really wasn't sure. I think markets are concerned about the deficit in the U.S., but they also like higher yields. So, and what we've seen is that the usual correlation between rates differentials and the dollar has largely been restored over the last months or 2 months. So it's very ambiguous, I think, right now.
Okay. Hi, Steve. This is Kanishka also joining in. A very good morning to you, first of all. Now, I want to understand from you, now, apart from the tax bill that we just spoke about, the tariff deadline of July 9, that is also looming. And, since the tariffs were announced in April, we have recovered from those lows. In fact, in the U.S. market, S&P 500 and NASDAQ, they hit their records in the first half of 2025. But then a very interesting trend that we saw yesterday, tech stocks have taken a hit in the starting the second half of this calendar year. So where do you see the next leg of move coming in for the US markets? And also if you could comment on what kind of global risk sentiment do you see shaping up because of the tariff deadline looming?
Well, I think that part of the reason U.S. equity market performance has been so good, and part of the reason the dollar has been so weak, is that the market has become more optimistic that the July 8th or 9th deadline is not going to be resolved in an aggressive way, the way the April 2nd was, but it will end up being relatively benign. And I think, the market would love to see the status quo. I know it sounds crazy because everybody is tariffed up. But I think there's a sentiment that the world can live with the 10% baseline tariffs. And they're hoping that the U.S. kind of does do a couple of deals, delays any sanctions, lets negotiations continue. And that's pretty much what's priced in. I think when you're looking at the second half of the year, I think the market is at a certain point going to have to look past both the tariff debate and the fiscal bill and say, what is the outlook for growth? What's the outlook for profits? And again, I'd say that it's more ambiguous. It's not clear that there is that much supply side incentive that's priced into this bill. So we'll have to see how markets react. But it's also possible that, exogenous factors, that we just see AI implemented and contributing to profits and productivity, that gives a better tone, completely independent of policy.
So that's as far as tariff is concerned, but also wanted your thoughts on the US dollar and especially dollar index, which continues to trade at the lowest level that we have seen since 2022. How do you see the US dollar moving and what kind of impact will that have on other currencies as well?
Well, the market is very negative dollars. Sentiment is very negative dollars. Positioning is negative dollars. And I don't think that global asset managers and investors have sold all the dollars or hedged all the dollar positions that they want. And again, I'd say that there are different forces in play. In longer term, it may well be that the dollar continues to fall. But if we end up having yields backing up, the market will have to decide whether to chase yields, which they've done so often, or treat that yield back up as a risk premium, which would be negative dollars. So overall, I'd say the longer term picture is probably not great, but I think there's balance of forces in the near term that could keep dollar volatile.
All right. Thank you so much, Steve, for that view. But with that, we'll let you go. Thank you so much for joining us this morning and helping us decode the global market setup. All right, then moving on.